The capital asset pricing model relies on a very specific structural assumption. It treats systematic risk as a perfectly symmetric force, assuming an asset will react to market volatility the exact same way, regardless of whether prices are surging or collapsing. To measure this risk, the model uses standard market beta, calculating an asset's overall sensitivity to historical market movements and distilling it down into a single terminal number. For decades, the financial industry has relied on this single metric to evaluate portfolios. But condensing all market behavior into one number masks how an asset actually behaves when a crash replaces a rally. To accurately model downside exposure, we have to mathematically bifurcate systematic risk into two separate opposing measurements. A portfolio with a beta of 1.0 might perfectly track the S&P 500 during a 10-year bull market, but that exact same portfolio can still suffer severe asymmetric drawdowns the moment the market turns negative. This scatter plot shows a standard ordinary least squares regression, plotting an asset's returns against a benchmark's returns. CAPM draws a single, solid trend line through all of this data to give us our standard beta. But when market volatility introduces extreme negative returns, that single line often fractures at the origin, splitting into two completely distinct trajectories. Based on the downside capital asset pricing framework developed by Javier Estrada, these two new slopes represent upside beta and downside beta. Under normal conditions, these two specific betas will average out to equal the overall standard beta. However, knowing the average does not allow you to reliably predict the specific angle of either individual slope. By breaking the regression line into upside and downside components, quantitative analysts can mathematically isolate a fund manager's exact directional sensitivity. In active portfolio management, this asymmetric risk is observed through up and down capture ratios. The up capture ratio measures how much of a benchmark's positive returns a fund captures, while the down capture ratio measures how much of the losses it absorbs. There is a strict mathematical constraint for calculating these ratios. They must be derived using geometric compounded returns across isolated benchmark months, rather than simple arithmetic means, to properly account for the compounding effect over multiple periods. This graph charts Vanguard growth against Vanguard dividend appreciation. Growth captures 112% of the upside, but absorbs 108% of the downside, yielding a 1.04 ratio. Dividend appreciation captures 87% upside, but limits downside to 68%, achieving a superior 1.28 ratio. On a $100,000 investment, this discrepancy has a severe dollar impact. The dividend fund ends the cycle significantly ahead of both the S&P 500 benchmark and the growth fund. Superior downside protection geometrically compounds into massive long-term wealth preservation, even when the asset severely lags in upside participation. To apply this absurd asymmetry directly to asset pricing models, we have to translate these capture ratios back into covariance math. This equation represents Estrada's downside beta, calculating the co-semivariance of portfolio and benchmark returns. By using the minimum function bounded by 0, the formula aggressively zeroes out all positive returns, isolating the calculation to periods when the benchmark drops below its average. Upside beta mirrors this exact mechanical process, restricting the data purely to periods of positive benchmark growth. Because this bifurcation effectively cuts the usable data points in half, calculating co-semivariance requires much larger historical datasets. Small sample sizes lack the statistical weight to accurately represent asset behavior in restricted periods. The true measure of a portfolio's risk is not its total variance across all conditions, but its restricted co-semivariance, specifically in down markets. Researchers Ika Prativi-Simbolan and Maria Yus Trinity Irson put these models to an empirical test using liquid stocks from the Indonesia Stock Exchange. Using 5 years of monthly data, they applied the Fama-Macbeth regression methodology to test standard, upside, and downside betas against actual cross-sectional return variations. This data table displays the results of Model 1, which tested conventional beta as the sole explanatory variable. It yielded an A-squared value of just 0.0622, alongside a negative coefficient. This result represents a statistical failure. It proves that standard beta was essentially uncorrelated to expected return fluctuations. This second table displays the results of Model 5, which stripped out the downside data and tested only upside beta. Here, the R-squared value hit 0.4643. The magnitude of this jump is severe. By mathematically isolating the risk metric, explanatory power surged from roughly 6% to nearly 47%. This exposed a specific behavioral reality. Investors in this market were vastly more sensitive to upside market shifting than they were to conventional symmetric shifting. Ultimately, cross-sectional variation in expected returns is driven by asymmetric risk preferences, invalidating the robustness of standard CAPM. This dashboard illustrates how portfolio managers organize performance metrics. Metrics like Jensen's alpha and the trainer ratio measure efficiency, while capture ratios and dual beta map directional behavior. Jensen's alpha serves a highly specific function. It relies on regression analysis to generate a single, risk-adjusted number that proves whether a manager added value beyond basic CAPM expectations. Capture ratios and dual beta serve a contrasting purpose. They split performance by market direction, revealing a fund's asymmetric behavior without letting a strong rally mask a terrible drawdown. Institutional investors combine these tools to form a complete picture. Alpha quantifies overall skill, while capture ratios diagnose directional capital preservation. Building modern portfolios on the assumption that systematic risk exerts a perfectly symmetrical force leaves structural blind spots in a manager's risk assessment. In quantitative finance, asymmetry is the reality. If your models assume symmetry, you are flying blind into the next market drawdown.